Last year, you were probably as close as anyone to calling what happened. So everyone wants to talk to you now. And you say you do both sell and buy side, but for a sell side guy, you say things that might run counter to consensus where you can actually get in trouble for actually making a prediction. You actually have to live by your predictions, and you're comfortable with that.
Well, look, I mean, if you're investing, you have to look forward. I mean, you have to try and predict what's going to happen, particularly in stocks.
You've seen most sell-side guys know how to not say anything. That's how they keep the job for so long, and that's not what you're doing. So what I said to you out there was, we were at 3,050, and I had talked to you on Fast Money, and I was like, 3,050, he's at 2,750. Couple of tweets from Trump about tariffs, you're back in the game totally for the 2,750 target. Although we're probably getting near 2,900 today. But last week, we were right in your range again, right? How do you, I mean, you don't know tweets are coming. You just base it on fundamentals, get a number, and stick with it.
Well, that's right. I mean, our fundamental work dominates our targets. And, you know, part of our call was that we thought a trade resolution was unlikely. We thought that after the G20 meeting back in June, it didn't look promising that anything was going to get done. So that was, we thought a lot of good news was priced for that, number one. But the real reason, I think, in that last time we were together, that made me somewhat more pessimistic is everybody was too bullish on the Fed. Right? If you go back in history and look at the Fed, when they pause, it's always positive. When they start cutting rates for the first time after a long pause, it's usually negative, because what it means is that things are deteriorating faster than what people were expecting. And that's exactly what happened. So the market topped the day that the Fed cut.
You say the Fed put is gone. Now, the Fed, that not for lack of trying, though, right? It's just that they're not getting they won't get the response they're hoping for in terms of a Fed put.
Well, they will eventually. Okay, so normally when the Fed starts cutting, it takes more than one cut. And the market was disappointed they didn't do 50. Our call was for 50, and we were wrong. We thought they would do 50 and try and really shock the market. They did 25, and now they're going to have to do more. They've signaled that, and eventually they'll get ahead of the curve. And so our big call, our big thing we're looking for to get more bullish is the curve needs to re-steepen from the back end. I mean, once the back end starts moving up, that'll be a sign that the bond market believes that the Fed now is in front of it, and we can look forward to the next recovery.
But they're using some backward data still to be, and that puts them behind the curve, and by all accounts, markets are telling you we're not in mid-cycle. We're in late cycle. The bond market and the stock market is saying late cycle to you.
It's saying end of cycle.
End of cycle.
I mean, that's what it says. I mean, inverted curve for 6 months. At the front end, you've got cyclicals really underperforming dramatically for the last 12 months.
Too late to sell them, though, right?
Well, I don't think it's
too late to sell if you think there's more down room.
I think the cyclical, we're still underweight cyclicals, okay? We're still overweight defensives. That's how we've been for the last year. I'm not saying it's too late. If you're overweight cyclicals, it's not too late to trim back, okay? But it's too late to totally upheaval your portfolio. It's not going to be as bad as last year. Why? Because the Fed is cutting now, Joe. Last December, they were still raising rates and talking about autopilot. So the Fed's doing their job. They're moving. They're just not moving as fast as the market maybe wants them to.
When you're saying about an upward yielding curve, are you talking more that the Fed cuts and then the curve steepens, or is it do you see the 10-year kind of going up? And if that's the case, what do you think causes that to go up at this point?
Well, I think there's two ways the back end can move out. Either the market starts to think that growth is going to improve even without the Fed cutting rates, or the Fed starts to cut more aggressively, and then the market looks forward. I think it's the latter, okay? Our call has been for a long time, we didn't think this was an insurance cut, okay? We thought this is the beginning of a long rate hike cycle, or rate cutting cycle, because the economic growth was deteriorating faster than people appreciated.
All right, you do have a bull case, a base case, and a bear case, and I want to just drill down on it. The multiple stays about the same. It's 16.7 on the bull case and 16.1 on the bear case, so it's all about the S&P earnings that you're talking about. And the one number that really gets me is in your bear case, an S&P of earnings of 149. That would be down like 10 or 15%.
That's a recession, a full-blown recession, like a bad recession.
And that could give us a 2,400. That's what we'd need to get the S&P to 2,400, which is it's not that long ago we were there anyway.
In December, you basically got
that. Not the end of the world, but we could get there again based on earnings dropping 10, 15%.
That's right, and that's been our call for a year and a half. We called for an earnings recession last year. Well, we are calling for an earnings recession, okay? But the 149 would be a worse earnings recession than our base case. We still think the consensus numbers are about 5 to 10% too high for the next 12 months. That's why our base case is lower than the consensus.
166 in the base case for the S&P. That would be kind of flat with
correct. 2 years of flat growth, basically.
For 2020, 166?
Yeah.
That's not consensus at all.
That's not consensus.
182 is consensus, would you say?
I think it's about 180 right now. On a bottoms-up basis, I think the top-down is always a bit lower. So I would compare it to the top downs, which are probably closer to 175. But we've been below the consensus on earnings now for the last 18 months, and we're highly convicted in that. That's been our main call. The earnings call has been highly convicted. The economic call is tougher.
Mike? Or is that a global slowdown call? Is that a bond market call? What is that?
No, this is a call about corporate profit margins. Right?
Margins.
This has been our call.
Because wages going up? Or?
Well, there's three things, right? So if you think about the real mistake this cycle, the policy mistake, it was the timing of the fiscal policy, not the fiscal policy itself, which we agree is a good policy choice, but doing it at a time when you had full employment already. You had an economy that was working really well for most corporations. Companies were finally spending. To do a $1.5 trillion fiscal stimulus then, that's not good that's not good timing. So that caused the economy to overheat last year, and that caused margin pressure because when you overheat the economy, you got overspending in CapEx, you got overspending on inventories, and you got labor cost pressure.
Those are all the things that people complain we haven't seen.
We're seeing them, Joe. They're in the numbers. I mean, it's a fact now. But margin pressure is real. We're seeing 100 to 150 basis points of deterioration in margin forecasts at the S&P level for this year relative to a year ago.
You see inflation. You see capital spending being more than it should. And you see wages also rising faster than.
And now they're deteriorating because companies are doing something about it. So that's how you get a recession. We're not officially calling for a recession yet. We think the risk is elevated. Okay, and it's probably 40% chance. And the only thing separating us from a recession in the U.S. is that companies decide to start firing people because they want to protect margins. They're already cutting back on CapEx, and they're already cutting back on OpEx and inventories, and that's slowed things down. But they haven't yet pulled the labor lever, and they may not. They may be able to get through this.
You're not even talking about Europe or the global slowdown.
Well, it's part of it. Because Bill,
it just adds to your case.
Of course. Look, 70% of the PMIs around the world are below 50 now. 70%. So more than two-thirds. That's way worse than 2015-16. The market PMI here in the U.S. breached 50 for the first time last week. Okay, and we get the new number for August in a couple of weeks. So it's happening. It's slowing. The only question is, does it tip over into a full-blown recession? Look, I think the market has already priced 80% of a recession at this point. That's what the bond market's telling us. That's what the stock market's been telling us. That's what the sector leadership has been telling us. That's what the commodity markets are telling us. So let's not get wrapped around the axle here. We're well into this correction. This has been a cyclical bear market. It's a consolidation of the secular bull market. It's a cyclical bear market that's frustrating to the bears because the bottom's not falling out either. Okay, and that's a healthy development. So longer term, we're actually pretty constructive. We think if you actually got a recession, it would be a very good catalyst to finally get more fiscal, which is really what we need to do to get out of this secular stagnation wave.
Well, talk about bearing the headline. That's a totally different take than I anticipated off the top.
Well, he's saying way too many things you can be called on 6 months from now. So we will be able to test whether we do 166 or 182 in the S&P next year. We'll be able to see whether.
That's right.
If you're right, you're going to leave Morgan Stanley because you're going to go to a hedge fund and make 10 times as much money. And if you're wrong, I guess you'll learn your lesson and not really be so specific all the time.
Well, I mean, it's our job to take risks, Joe. So we have to make a prediction. And by the way, we're trying to guide client assets. Okay, I mean, we have a big wealth management arm, and we need to be early because we're large. So that's our job. Our job is to keep clients out of harm's way.
We appreciate it,
and take risks.
I hope you'll be back. How long do you think you need before we start? You have something new to say. 3 months you'll be back here?
Depends on how fast
write that down now?
I would say that this quarter, I stand by our call, 2,700 this quarter. So that could be relatively quick. And at that point, I think there will be something to do for the first time in quite a while where you're now pricing in a pretty good recessionary outcome risk. And at that point, you have to step in.
You actually have places to put money in here, too. You actually have some fresh money ideas, right? We could do, right?
That list has done really well because it's been defensively oriented. And you can see by the makeup of the list, it's either really defensive-oriented stocks or very high-quality-oriented stocks.